In this tutorial, we're going to take a look at the effect that the interest rate, the rate has. So what effect does the rate have on the interest you pay, the amount of interest you pay over the life of a loan or mortgage. Now, so before we get into that, we're going to talk about a term called amortization. So what does amortization mean? You may have heard that before, perhaps not. The term amortization refers to spreading the cost of something over a long period of time. A loan for something smaller, like let's say a used car, could be just for as short as a year or a couple of years. But buying a home could be spread over 20 or 25 or even 30 years. So there's a big range in the amount of time that can be spent over. Now, in a business context, purchasing a larger item, such as machinery or a vehicle, the business is allowed to declare this cost as an expense over a long period of time. Now, when I say declare, in their business statements, when they're trying to figure out how much tax they're supposed to pay. So expenses help a business to reduce how much tax they pay. But if they buy something like, let's say they bought a $90,000 SUV, they cannot use that expense in a single tax year. It would be expensed over several years. So instead they amortize the expense over multiple years. Perhaps they're allowed to declare it over, let's say, 5 years. So they would divide 90,000 by 5. And actually, it might not be as simple as that, because there's probably going to be some value to it at the end, at the end of 5 years, for example. But they would be able to use part of that for each of several years in their business statements. Now, the definition of amortization these tutorials are using refers to the repayment of a loan from bank over time. And tutorials at the very beginning, this is Financial Literacy Part 2. The first one was on what is interest. Now, typically, if you purchase a house for, let's say, $300,000, most people cannot pay that whole amount immediately. So getting a mortgage, the mortgage is the name for a loan to buy property or a house, allows you to pay the house off over a long period of time. So you don't have enough money to pay for the whole thing, so you get to pay it off over 10 or 15 or 20 or 25 or 30 years. The bank charges interest, okay, that's their fee, for your convenience. So the buyer of using their money to pay the seller. Now, the person selling the house, if you're on that end of the deal, they get their whole amount immediately. The purchaser pays the loan off over a period of time, maybe even a long period of time, like 20 or 25 or 30 years. Now we're going to take a look at this calculator. So I'm going to pause for a second. So this is the amortization calculator I'm going to use in these tutorials. There's a lot of different ones out there. If you, for example, live in Canada like I do, you really should use one that uses the rules for Canada. So you can tell probably easily that it's .ca. Now, if you use one that was, let's say, set up for the United States, for example, the amount is only going to be very slightly different. But if you live in Canada, use one that's made for Canada. One of the differences is in Canada, the interest rate is actually compounded differently than it is in the United States, so it makes a small amount of difference in how much you're paying. This is the default. When you start this up, it has $500,000 here, 2% interest rate for 25 years or 300 months, so it actually shows you both. And you can, I'm going to do most of this monthly, but you could also change to bi-weekly. Like if you have a job that you get paid every 2 weeks, then you may as well do bi-weekly, because that's in the same frequency as how you're being paid. If you're paid every month, then maybe the monthly payment is best. So now this is just some advertisements here. When you click on calculate, it actually shows you, okay, so the principal payment is the $500,000. The monthly amount would be $2,117.26. The total interest payment for the entire life of the loan is $135,000 over the 25 years. So if you add the two of these up, the $500,000 principal payment, which is what the amount you're getting the loan for, plus the interest, so that's your whole cost of borrowing over the entire 25 years. There's a lot of other things down here. So this actually, some of these graphs are useful for depending on what we're trying to do. So this actually shows the amount of the mortgage left. So right at the beginning, well, actually after one payment, you're still owe $498,712.60. But if you scroll down here, let's say 10 years is 120 months. So 10 years, you're $329,000 left approximately. And actually, these two actually show the monthly payment, but how it's broken down into the principal that's being paid and the interest being paid. So right at the beginning, notice the principal payment is $1,287, the interest is $829, and the further you go, notice that the amount of interest you're paying each month is going down and the principal payment's going up. So for example, after 52 payments, which is, let's see now, a little more than 4 years, 4.5 years almost. The principal payment on that one is $1,400, and the interest you're paying the bank is $716 approximately. And so it goes. So near the end of the loan, see the interest payment on payment 288 is only $52. It's 286 there, $52, and the principal amount coming off the loan is over $2,000. So there's a few extra things here. This actually shows for each of the payments the interest is being paid and the principal. Now, these two always add up to that monthly payment. Okay, so for example, if I take my calculator here, I'm going to add up 1287.37 plus this 829.88, 829.88. See, that's 2117.25. We scroll up. See, it's only a penny off. That is the monthly payment. In fact, for any, we go down here, let's say the 12th payment, if I add 1311.07, that's the amount coming off the balance of the loan, the principal, and add to that 806.18. See, that is still the monthly payment. So the amount that's coming off, like what you owe the bank, goes up a little bit each month, and the interest goes down a little bit each month. The interest starts fairly high, and of course for higher interest rates, you'll see this a lot higher. We'll talk about that in another video. But that's how this website works. I'm going to go back to the PowerPoint now. So the whole point of this, and we're talking about amortization, and the website, but is what effect does the interest rate have on how much interest you pay? So what I did, I used that website with the $500,000, 20 years, and I first put 0% in, and then 1%, 2%, 3%, just as a comparison. Now, you're not going to get a mortgage for 0% because the banks, they don't give money away for free. Okay, you could get a car loan, for example, or for a truck or an SUV or something like that for 0%. They have that deal on once in a while, but not for a mortgage, no. But anyway, if your interest rate was 0%, then the total interest payment would be zero. And if you borrowed $500,000, in the end you would pay $500,000 back. Now, if we go up to 1%, the total interest payment over the whole 20 years is almost $52,000, $51,762. If you increase from 1 to 2%, so notice actually 0%, that was the monthly payment. 1%, it's almost $2,300. So notice it's higher. For 2%, see the monthly amount has gone up too. Okay, and the total interest you're paying has gone up too. This is approximately doubled. If you take about 52,000, double would be 104. So it's slightly more than double. And if you go to 3%, notice that the amount you're paying each month has gone up more, and of course the total interest you're paying has gone up more too. Okay, so the higher the interest rate, the higher your monthly payment, and the more interest you're paying over the life of the loan. So that's the whole point of this tutorial. So the higher the interest rate, the more interest you pay over the life of a mortgage or loan, and the higher your monthly payment or biweekly payment. So that's why it can pay to shop around to look for a better interest rate. Perhaps this particular bank is charging, let's say, 3%, maybe another one you find for 2.5%. And that 0.5% might make quite a difference over the life of the loan. And that's the end of the tutorial.